Good evening, ladies and gentlemen. It's a pleasure to be here. I've been given 10 minutes to talk about the FX market outlook. And I have to learn from my earlier speakers how to speed talk. So you may have to bear with me if I go over my time. Okay, let's start. So over the last 2 years, ladies and gentlemen, there's a clear winner in the FX market, which is the king US dollar. Now that's obviously backed by a rapid rise by the US Federal Reserve from 25 basis point to 5.5% in less than 18 months. Also backed by strong economic performance and also some preference for safe haven currency given some of the geopolitical development around the world. As you also heard from William, the next cycle of rates are likely to be coming off. And our house view for the US dollar Fed funds is 75 basis point cut starting in June this year. But does that necessarily mean that the US dollar will reverse its trend and start falling down? We don't think that may be the case. We have started looking at charts, looking at short-term interest rates, which is the 2-year swap rates. That's the part of the interest rate yield curve that actually prices in future expectations of the overnight rates across many currencies, G10, including the US dollar. That sharp drop in the black line basically says, yes, generally the market has started pricing in rate cuts to come. But if you look at the red line, the dollar index, which tracks the strength of the US dollar, hasn't really moved down as much. And in history, if you look back at 0809, when interest rates saw a very sharp drop, dollar index actually went up. So we have observed in history that the strength of the US dollar does not necessarily reverse when interest rate starts coming down. Why? Because there's this thing called risk sentiment. Now back then, if you remember, there was a great financial crisis. Some countries went into recession, but there was also a global slowdown in GDP across the world. Now that basically means risk appetite to invest, to diversify out of the US dollar was poor. So other than interest rate move, risk appetite is the other factor that actually determines the movement of currency. Yep. We also look at risk appetite from movement of the currency against performance of the equity market. Before 22, there was a somewhat inverse correlation where equity markets comes down, the dollar value goes up. That inverse correlation seems to have broken in the last year or two. And that basically means that the market is still uncertain as to price in whether that inverse relationship will continue. And if you look at consensus that is built out and put out by various banks in the Bloomberg and so forth, consensus is looking at going forward, perhaps the dollar may come down, but HSBC's forecast is we don't think so. We still think that the US dollar may remain strong. So I've touched on the three factors, which is basically global growth sentiment, US dollar exceptionalism, given all the three factors that I mentioned about high rates, sentiment, and also safe haven, and also direction of interest rates. We still think that the dollar has some value to be kept because although there may be interest rate coming down in the US, there may also be interest rate cuts coming through in other parts of the world. It's not just the only country that will be cutting rates. So that's likely to remain strong. And this is a chart that we track in terms of surprise activities. It's basically economic activities that outperform expectation. There are a lot more coming out from the US in the last few months than other parts of the world, which is basically some of the key economies that's highlighted there. So what we're saying is there's still spikes of surprise activity that's outperforming in the US versus some of the other countries. And the link to US dollar yield differential. Now, if rates start coming down in the US and other currencies are also cutting rates, that yield differential is key. And it may narrow in terms of where we are today into the months and years ahead, but the link to the US dollar may not necessarily be the same. And we've also seen that by tracking and looking at certain periods in history in 95, 98, and also in early 2019, where when the Fed start cutting interest rates, the dollar index actually went up. So in summary, what we're saying is, do not assume that when rates start coming down in the US, we can expect the dollar to reverse its trend. Let's talk about euro. Now, in the past few months, we have seen a little bit stronger value in the euro. That's largely because there's an increase in current account surplus, given lower imports, and also in terms of increased FDI into the Eurozone. In the last few months, we have also seen that the yield differential in the euro market versus US has also started coming down. So it does seem to us that the euro is somewhat overvalued, and we do not think that this is likely to continue. So we are a little bit cautious about where the euro is currently, and perhaps there's room for it to see a little bit of weakening in the future. The signs of the higher interest rates in Europe is taking toll on its economy. And this is also shown in the credit growth, which is basically the amount of loans that's given in the banking market to various households and corporates. That loan growth has also been declining. Obviously, with higher interest rates, the cost of borrowing has gone up. Demand for loan has also started coming down, and banks are lending less. And likewise, inflation, I think that is easing in the last few months. All these are also supporting the fact that it's not just the US that will cut rates. We are likely to see the ECB reducing rates as well in the near term. The picture is somewhat similar for sterling pound. Again, the high rates in the UK is also taking toll on its economy. Likewise, same observation in credit growth or loan growth in the UK, as well as the lowering inflation rate may also give rise for a more supportive and easing policies to come in the UK. And therefore, we think that both these European currencies, so euro and sterling pound, may just see a bit of correction coming off later in the year. Closer to home in Asia, we have to look at renminbi, which is one of the largest economy in the world, and where most Asian currencies are now finding more and more correlation to how this renminbi is performing. Since third quarter of last year, as you would recall, there was some stress in the property sector in China, and the renminbi went to 7.3-ish, which we think would have peaked for the dollar, and we have seen a bit of a gradual recovery given the stimulus package that the Chinese government has introduced to save or to ease, and which is stabilizing the property market, and also rate cuts that they have delivered in China. Somehow that has also eased some of the pressure on renminbi, and we think that going forward, the GDP may not necessarily be as bad as people are talking. It's still going to be somewhat high force, and that's likely to provide a bit of relief to the renminbi with a slightly stronger appreciation towards the 7.1 level. Just to touch on Indian rupee as well. In the past 1 year or so, the Indian rupee tends to be a lot more stable. In fact, it's one of the more stable currency around in Asia. Why so? Actually, there's been quite an active management of the currency by the central bank, which is RBI. Now, the last few years, there's been increase in FDI into India, and of late, the local currency bond market in India has been announced to be included in the global bond index, effective, I think it's June this year. I think my colleague, the next speaker will cover a little bit more on that. So there's a bit of excitement coming through in terms of flow of money positioning into Indian rupee. But somehow it hasn't appreciated as much as we expected. And that is actually an act of intervention, as I mentioned, by the central bank accumulating these US dollars. They're buying these US dollars that's coming in to shore up their reserves, their foreign currency reserves, to position themselves for better defense in the future. So our view is that for Indian rupee, it's likely to be a slight appreciation, and one of the other currency that is getting some relief from what's happening in the US. Sing dollars, well, this is the one currency that is very strong in Asia. We still think that it is somewhat a bit overvalued, but that's largely guided by this very high slope in terms of the guidance by the MAS on this nominal exchange rate, which we think in the months ahead, there may be perhaps some change in terms of the indication and guidance to the market. But however, I think this currency is still likely to hold its strength, to be a lot more stable than most other currencies, although the slope of the NER may not be as steep. It may be able to hold its value as a currency. And of course, we have to touch on ringgit. In the last couple of years, we have seen gradual weakening of the ringgit. There was some outflow in terms of investments from local funds. Foreign funds, there was some inflow, not so much from the equity market, but in the bond market, there was a net inflow of about $3.5 billion last year. Of course, there's some outflow in the equity market, so net, we're still seeing a very small inflow. FDI has increased. I think that's good news. So we can expect to see more FDI, hopefully in the near term. Then again, in terms of interest rate differential, we may get a bit of relief as US starts cutting rates. And our house view is that for Malaysia, OPR is likely to stay stable for the rest of this year, likely into next year as well. But that narrowing yield is likely to provide some relief to the ringgit. And we do expect the ringgit to strengthen a little bit gradually towards the 4.5-ish by year end. I will stop right here and happy to pass on to the next speaker. Thank you.